How much percentage-wise should you be shooting for in your trading account per year? Today, I'm going to cover all about percentage gains on your account, what's realistic, what's a little bit ridiculous to me, and what I personally shoot for each year on my trading accounts. Stay tuned. Let's get into the video right now. So welcome back, traders, to another one of my YouTube videos. My name is Nick, and I make all sorts of currency exchange and Forex and stock market information here on the YouTube channel. I share strategy ideas and all of my own research, as well as just kind of keep my own journal here on YouTube. So if you're enjoying my content, I do want to ask, make sure you subscribe to the channel down below and also give this video a thumbs up. It helps to share this message to more people. So again, today we're going to be talking about percentage gains per year, and I'm going to be going over kind of my opinion about what's realistic in this department. Now, this is kind of a fuzzy area and not something a lot of people will talk about, other than on Instagram and on YouTube, where people will shout that they can, make, 500% per year and that sort of thing, which is to me kind of more on the ridiculous side. And that definitely sells easier. If I wanted to just make a bunch of money, what I would do is I would just say, buy my course and you could, make 500% per year. But this YouTube channel from the start has been about telling the truth, and I'm all about what's realistic. In my own trading, I'm looking to go for more of a realistic number, which we're going to get into in just a second. So percentage gains per year, if you don't know what this means, and essentially what we're talking about is if you have some sort of amount in your account, let's say you have $5,000, and what is a reasonable percentage gain or kind of increase on the account equity or balance over the course of 1 year? Year to year, what is kind of your target amounts? Now, what I want to say is that for the most part, in the last kind of several decades, kind of as a summed up version, the S&P 500, we'll put SPY. This is the conglomerate of the top 500 Fortune 500 US companies, right, on the stock market. This on average has gone up about 7% per year. Okay. This is the market. And there's an entire debate in the world of finance about the fact that, can you beat the market? Can you beat the average of the market? And when people usually say that, they're talking about the Dow Industrial, they're talking about the SPY, right? They're talking about this index right here. So if the market goes up about 7% per year on average, historically, we are looking as traders to be more active and to potentially do better than that. If you do anywhere better than the S&P 500, you're doing very, very well. Essentially, a lot of the finance world thinks that it's very, very difficult and very unlikely that you beat the average. And that is absolutely true. It is very difficult to beat the average, regardless of what you see on Instagram, regardless of what you see on YouTube. The top people on Wall Street debate this endlessly, that something like 7% or more is very, very difficult to attain consistently over the years. Now, in my own trading, I've been active all the time. I'm always looking at the charts. I'm looking for opportunities, and I go for a bigger number than this, and a lot of people do as well. But I just want to give some context before I go any further that the S&P 500 on average goes up 7% per year, and this is considered a relatively stable, relatively strong investment over the years. So 7% per year is our benchmark. It is our starting kind of what we can shoot to try and beat. Because if we're trading on average, all the time, if we're active, we'd likely want to be making more than this. Now, it's easier said than done, because remember, most traders, do you care to take a guess what they make? They actually make negative percentage per year. So most traders and investors are losing money overall. Now, this is due to a kind of a ton of reasons. One of the major reasons mainly being emotion, right? A lot of traders struggle with the ups and downs, the greed and the fear and all the things that kind of hit us as traders psychologically. That can make things very, very difficult for us. As active traders, especially because we're looking at our investments and we're looking at our trades constantly. So if we're trying to beat the S&P 500, the 7% per year, for me, something like 20% is actually a really solid number. Now, I know that might not be crazy to a lot of people. A lot of people are like, 20% sounds not very exciting, Nick. That's not going to make me a zillionaire. And to me, trading since the beginning on this channel, again, has been about being honest. It's been about what I found over the years and sharing my research and an analysis of the markets. And my background is in computer science. I've built, hundreds, literally hundreds of trading systems, trying to back test over the years to see what was attainable. And what I found is that with relatively low risk, 20% is something that is doable goal, but is something that you're gonna have to put in a lot of work to get towards. So 20% is not even easy. A lot of people will say, oh, 20% is easy, I could do that in a day. But what they don't realize is that risk is very, very important to any long-term trader success, right? We don't need to be worried so much about the reward. We need to be focused primarily on our risk relative to our reward, because we want to keep our risk down and we want to keep our reward as high as possible, right? Ideally, we have some sort of more reward than we do have risk. And in fact, we want to be shooting for more than 7% per year if we're going to be trading actively. Otherwise, we could just put our money in the S&P 500 and wait, right? That's kind of the common argument for the buy and hold people who have been doing that for quite some time. And truthfully, it's been very, very difficult. Historically, hedge funds and a lot of money managers have struggled to beat this index. Us as traders, however, have some sort of perk or some sort of benefit, which means that we're using less money than a lot of the institutions. The more money you have, and institutions have a problem because they need to move so much money, and this makes it hard for them to move quietly in and out of the market like us retail traders. So in some ways, we do have some things that go for us. Not all things. A lot of things are balanced way heavily on the institution side, but there are some things for us retail traders that we can use to our advantage. So for me, 20% per year is something that is realistic. Not to everybody. I know people will disagree with me harshly, but hear me out on this. My goal is 20% because I want to keep my risk low. I trade part of my living is off of my trading. I also have a software business. I also do social media consulting. So I have a couple different streams of income. But for me, 20% per year on my trading is something that will help pay the bills. It will help kind of make enough money for me to sustain myself. And so 20% per year is a reasonable number, because if you're working towards trading for a living, if you want to trade full time, you need to ask yourself, what can I do consistently? Not what can I do every once in a while, right? Because sometimes people will say I can make 100% per year. And based on my last year's performance, if I tried to make 100%, I could have done it, but maybe next year I might have blown an account, right? That's my primary goal, is to avoid burning accounts or blowing up accounts. So if we're going for something like 100%, you inherently take more risk. And to me, the goal is to not do this over the course of a few weeks or a couple months, but to do this years in the future and to continue to compound an account. Before you hate on 20% per year, or 10 to 30%, that's kind of the range that I'd look to make per year. And it's possible to even have negative months and negative years as a profitable trader. That's part of the game too. Trading is up and down, right? But before you hate too much on 20% per year, the idea that I have here is that this will compound and grow over time, right? I'm not looking to do this on my trading equity, right? Because this comes with all sorts of crazy movements. Instead, my goal is to look for something like this, right? More slow, long-term growth that scales over time, right? That's the idea that I'm going for with that 20% per year number. Because after you make a year, if you have a 10 to 30% increase, well, that's money that next year you can use again and slightly maybe increase your position size so that you can make a little bit more. Guys, I know that this is not the shiny object thing that everybody wants to talk about in the currency exchange world. Everybody wants to talk about making 20% in a week or 20% in an hour, right? Everybody wants to talk about that. But to me, what's consistent, what's easier to achieve consistently is that lower number. Now, there is one more thing that I want to talk about with this concept, and it's that you can't have this 20% per year easily. Again, people will say all over the internet how easy it is to do this without any sort of kind of willingness to share how they're doing it, right? Everybody will say this is easy, but they won't share why. 20% in my experience has been something that's not easy to achieve. Now, if you like going for something more than 20% per year, that's fine. I'm not saying that you can't earn more than 20% per year or that this is the only number that makes sense. Not the goal of this video. The goal of this video is to share my opinion, which is 20% is a reasonable and realistic number to hit. But if you are to go for something bigger, let's say that you go for 40% per year, you have to accept that your risk is likely going to be higher. Why? Because you're increasing your position sizes, and whenever you increase position sizes, you expose yourself to more of the market's moves. So inevitably, we don't know exactly where the market's going. So anytime we increase our risk position, right, that kind of contributes to bigger swings, bigger drawdowns, that sort of thing. So for me, I'd like to keep those drawdowns low and that over time growth up. Again, going for something like this that compounds over time rather than trying to just shoot for big money really quick, because a lot of times that can result in huge drawdowns and huge losses. I will say one more thing you do need if you're going to trade for a living, you're going to have capital. That's the only downside to going for more consistent, more steady, more conservative gains is you need more capital to work with, right? If you have $100,000 and you make 20%, that's $20,000 per year, which is not, it's nothing crazy. You're not becoming a zillionaire off of that number, but that can help pay the bills, especially in my case, I have other sources of income as well. And so that could be something that's reasonable. And maybe next year or the years after that, this number grows to something like maybe 25,000 in the year, right? And compounding and building that account number, 25,000, right? Building that number over time is the name of the game, in my opinion. It's not about this year. It's not about next year. It's about 5 years, 10 years, 15 years. What are the accounts going to be doing? That's what matters to me. Guys, thanks so much for joining me for today's video. If you got something out of it, please give this video a thumbs up down below, and we'll catch you on the next one.